In today's session, on the second half of investor sentiment lecture, we will try to see some emotional factors which have been identified by the researchers, that these factors are likely to have influence on the decision making of individuals, and these factors in turn will influence the financial decision making of the investors, and consequently this will have impact on the movement of the stock market. So it is very difficult to list down all of the emotional factors which actually affect the decision making of investors, but at least we can identify some factors, a few factors which have been identified by the psychologist and which have been identified by the behavioral economist. So two of those factors are pride and regret. So you are very familiar with these two terms, pride and regret. Obviously, pride is a positive emotion and regret is a negative emotion. So if you have already made a decision and for some reason, maybe unexpected reason, it turns out that that decision was not good, or like that you have made an investment decision to purchase an asset, and it turns out that that decision was not good because that investment is underperforming. Obviously, you will make regret for that decision what you made earlier, and that is very common and that is very usual. And the situation of regret is amplified when there is a context that you have to report your underperformance to someone. Say it may be your family, it may be your spouse, it may be your parents, or it may be your boss, or it may be your supervisor, whoever is. In that case, the thing is that when you share some negative feelings, remember the negative feelings has come from the underperformance of the prior investment, and you are now supposed to report this to these members, what I just have mentioned. So when you share some negative feelings with someone, your feeling of regret amplifies. So that's why the investors who lost their money in investment, obviously they make regret for their poor decisions, but their regret get multiplied, or their negative emotion get multiplied when they have to report, or they have to share the thing, share the poor performance with someone. However, in opposite side, there is a pride. So if for some reason it turns out that you have made a good outcome from your investment or from your any decision, you are very likely to take pride for that. And for having pride, you like to share with your people, and your pride also amplifies when you share this with other people. So say some in last year you have made a good profit from your investment, and it is likely that for making good profit in last year, the pride has grown in your mind, and you will be likely to take more risk in this year. So in this way, regret and pride affects our decision making. How regret affects our decision making? If we know earlier, I mean, prior, we know earlier that we will have to regret for this decision. So what will be likely? It will be likely that I will not go for making that decision. Say I'm not very adept in stock market knowledge. So in that case, it is likely that I will make regret if I make loss in the investment in a stock market. So it will be very likely that I will make myself make myself away or keep myself away from the stock market investment, because I know that I will have to regret. So in that way, a regret influences our decision making. In the opposite side, how pride influences our decision making. So for some reason, what we have made earlier, what the reason we shared earlier, that for having good profit in earlier year, the pride grows in our mind. So in that case, what will be the consequence, or what will be the consequential influence in our decision making? It will be like that I will be taking more risk, or I will be looking for more speculative investment. Though in earlier year, I made investment from some investment which are not speculative. But as the pride has grown in my mind, it will be more likely that I will be taking more risk. But the thing is that which need to be noted, that the effects of pride and the effects of regret are not equal. They are asymmetric. They are asymmetric. You can probably recall from the prospect theory, which between gain and loss, which is in which people are more sensitive, in the loss region or in the gain region?
Loss region.
In the loss region, people are more sensitive. That's why people look for engaging more risk. So in the same way, it has been found that regret is felt more strongly relative to the pride is felt by the people. So one thing we like to repeat from the previous discussion or previous lectures, that is the disposition effect. Can anyone recall that what we learned in the disposition effect? What kind of behavior we like to define as disposition effect? Investors, when they have the tendency to hold their losing investment for longer time and sell off their gaining investment earlier or early, this kind of tendency we term as disposition effect. So from the gain and from the loss, in which case we will have more tax implication. I mean, we'll have to pay more tax if I have more gain or if I incur loss.
More gain.
So there are more tax implications. Okay. So if tax has more implication on the gain, which is to be done? Should I realize gain earlier, or I should defer gain and realize the loss earlier?
That's subjective, sir. If I'm thinking there is a more upside, I might need to hold on. If the every other aspect is the same, we should wait to realize the gain.
Yeah, but the thing is that in most of the cases, it is always advisable to realize the loss for taking the tax advantage. For taking the tax advantage and to defer the gain, though the context might be different, but it is commonly advisable. But what people do just the opposite. People realize the gain earlier and defer the loss instead of taking the advantage from tax implication for gain and loss. So one reason for disposition effect, I mean, what are the reason why people hold the stocks, winning stocks, does not want to hold the winning stock, but want to hold the losing stock for longer time? What is the reason? So one reason which can be stressed from the facts we learned in the regret, that if you incur loss, but that is unrealized loss, in that case, it is very unlikely that you will have to report to many people, or you will have to report your supervisor, or you will have to report your family members that I have this unrealized loss. But if it becomes realized loss, it is more likely that you will be sharing this information with these people. So in which case you will feel more regret if you keep the loss as unrealized, or if you make the loss realized, in which case you will feel more regret. If you realize the loss immediately, if you realize the loss immediately, it will become very clear that you have made a mistake, and you will be making regret for that, and you will be sharing this regret with others, and your regret will get amplified. So to avoid this cycle, what will be the likely behavior from you? To keep this loss as unrealized. Are you getting the things? Are you familiar with the unrealized loss and realized loss? Yes,
Yes,
no?
sir.
Yes,
sir.
okay.
Yeah, if I'm selling something and that's realized, until I'm selling, it's unrealized.
Right, okay. So in which case you will feel more regret? If you realize the loss, or if you keep the loss in unrealized, if you keep the loss as unrealized?
The regret is more likely to take place if it's realized, I think.
Yeah, you will feel regret because there is no more chance to get back, right? Okay. So people try to avoid this. People try to avoid this because if people realize this loss, and it will be very clear that I have made this mistake, and as I have made the mistake, my poorly made decisions, or as I can't take the decisions well, these things will be very clear to the people to whom I will be reporting. That's why people have a tendency to keep the loss unrealized. And if you try to relate with the pride, if you just try to take the opposite picture, I mean, in case of gaining position, in which case I will be taking more pride. If I sell the gaining or gain position early, or sell the gain position later, what will be the tendency of the people? People try to take the pride in a later time, or people try to take the pride earlier?
Earlier, sir.
Friday earlier.
Okay. So for the same reason, people have a tendency to exhibit the disposition effect. I mean, remember, people means here investors. Okay. Okay. So we'll try to see an empirical evidence that whether this claim is true, that this claim is true or not true. We'll try to test this hypothesis by looking at the empirical paper. We'll try to test this hypothesis. Are you familiar with the hypothesis? That you have made a claim and you have the data and you have made some statistical analysis. Now you want to see that this claim is true, or this claim can be accepted, or this claim cannot be accepted. Okay. So to look at the empirical evidence, before looking at the empirical evidence, we have to make some definitions or concepts clear so that we can understand that what are available in the paper. Okay. So you probably can recall that in prospect theory, there is a reference point here from which the gain and the loss can be measured. You probably can recall we discussed it in prospect theory, and that reference point has ambiguity, that it is not clear that how people set their reference point to measure the gain and loss. But in our discussion, the purchase price of the stock or the average price of the stock has been made as a reference point to measure the gain and loss. So, which is also natural reference point to measure the gain and loss in a stock market portfolio. Okay. So we will try to look at two ratios. One is PGR, one is PLR. So PGR is proportion of gains realized, and PLR is proportion of losses realized. So before looking at the definition of the concept, let me give you the idea from the portfolio statement. Probably you are very familiar with the portfolio statement provided by the brokers to the investors. So every day you get your portfolio statement. Every day means every working day, every trading day, you get your portfolio statement. So in that portfolio statement, the items in which you have made investment are listed. So say we have made investment in 6 items. So let's say these are 6 securities. These 6 securities are listed, and your average price will be listed, and your total cost for this will be listed, and the market value for this will be listed, and also the quantity, saleable quantity and the actual quantity, this will be listed also, and the profit or loss will be estimated, will be shared with you by subtracting the total cost from the market price, and also the return will also be reported by your broker. Okay. So say out of these 6 items, say in the first item, you are incurring loss. In the second item, you are incurring loss. And the third item, you are also incurring loss. And fourth item, you are also incurring loss. And in the fifth item, you are incurring gain. And in the sixth item, you are incurring gain. So in how many items you are incurring loss, and in how many items you are incurring gain? In 4 items, you are incurring loss, and in 2 items, you are incurring gain. Remember, the item means here the investment assets. Okay. say out of these 4 losing investment, you have sold out or you have closed 1 investment only. In that case, this loss of this 1 item will be realized. All these are unrealized, but when you have decided that you will make a closure of this item by selling out, what will happen? This loss will become realized. In that case, out of the 4 loss investment, how many loss investment you are, you are realizing the loss in how many losing investment? In 1 investment, okay. So in 1 investment, you have the realized loss. But you see that if I divide this number by number of realized losses and number of items in which we have unrealized losses, have you seen? Can you recall there are 4 items? So you see there are 4. Have you got this? How I have written the 1 plus 3? 1 is for that investment for which I have decided that I will go for selling this item out of this 4. For that reason, that is, this is 1. And I have divided this number by number of items in which I have realized loss plus the number of items in which I have unrealized loss. Have I got this? Otherwise, I can't proceed.
Yes, sir.
Okay. In that case, what is the ratio here? 0.25? 0.25. So this is the definition of proportion of losses realized, PLR. Now you this concept is clear to you. What have been written here? Is it clear to you? So unrealized losses has been named here as paper losses. Okay, this is alternative name. Okay. Now in the same way, out of the 2 gain investment, in 2 investment in which I have made gain, say I have decided that I will go for realizing gain of these 2 gain investment. That's why I have taken this 2. Now, if I divide this number by number of realized gain in how many investment? 2 plus. So if I have decided that I will realize gain in this 2 gain investment, how many items are remaining as paper gain? Or how many items are remaining as unrealized gain? If I have decided to sell of 2 gain position?
0.
0, sir.
It will be 0. In that case, what will be the ratio here? 1. Okay. So this is the proportion of gains realized. This is the proportion of gains realized. Now, the question for you before looking at the findings of the paper or findings of the research. If the disposition effect is prevalent or if the disposition effect is true, which ratio is likely to be greater, PGR or PLR? It should be greater or it should be greater? In which case, the frequency of transaction will be greater in disposition effect, in a loss or in gain.
I think gain, sir.
Yeah. So that's why PGR should be greater than the PLR, right? If the disposition effect is true. Okay, let's see. So Odion, in 1998, what he did, he looked at the transaction between 1987 to 1993 period, and for this number of transactions and this number of gains and losses, he concluded these findings. So let's see, in entire year, in the first column, don't try to look at other columns right now. Entire year, what has been found on an average, which one is greater? PGR is greater or PLR is greater? This
PGR is greater.
PGR is greater. So what does it indicate? People have a tendency to sell off their gaining position earlier, or people have a tendency to trade the gaining stocks more frequently relative to the losing stocks. Does it indicate this thing?
Yes, sir.
Okay.
Yes, sir.
So you see the difference is 5%, and this difference is strongly significant. You can probably recall that if the T statistic is greater than 2, sorry, if T statistic is greater than 2, right? If T statistic is greater than 2, it can be declared that it is significant. Note that. What is the T statistic here? 35. It is a big number. It is a big number for the entire year.
Yes, sir.
So it is a strongly significant, and it what kind of claim it is supporting? It is supporting that people have a tendency to sell off their gaining investment earlier, or gaining investment. People have a tendency to trade on their gaining stocks more frequently relative to the their investment which are in the losing position. Okay. Now let's come to this period, sub period. One sub period is from January to November, another period is December. You see the same picture in the January to November, that the PGR is greater than PLR. That means people in the year, in the period from January to November, are more likely to or frequently trade their gaining stocks relative to the losing stocks. You see the same picture? Yes, no?
Got it, sir.
It seems
Okay.
the same, sir.
Same. Okay, fine. Now you see the middle column, the findings is different from the first and third column. Remember, this is for the entire year, from January to December. You see, in case of December, the PLR is greater than the PGR. The frequency of trading the losing stocks is greater than the frequency of trading the gaining stock. You see, this PLR is now greater than the PGR. Let me give you some information that in December, tax is calculated, tax is estimated in the US market. Can you recall what we have learned in the discussion few minutes ago? For tax implication, what will be the tendency of the people to incur the loss and to get the tax advantage? So if the December is the time in which tax is estimated or tax is calculated, what will be the tendency of the people in the December? People will be deferring their gaining stock, and people will be more likely to incur the losses in December to have the tax advantage.
Yes, sir.
Okay, so that is the reason why the PLR is greater than the PGR in the December particular. Okay, so for the same tax reason, there is another market anomaly, which is not the subject right now. That is the January effect. Can anyone, has anyone heard about the January effect from any of your course? Okay, it happens for the same reason that for tax reason. For tax implication, people have a tendency to avoid the purchasing of, not purchasing, I mean, people have a tendency to purchase more stocks after the tax has been estimated in the December. So what is that period? In that period is January. So in January, people, more transactions are likely in the stock market, and more transaction will push up the price of the market and take the price of many stocks in the upward position. So it is very likely to see that most of the stocks are performing very well in the month of January. So let us try to identify some explanations that we have got the proof that disposition effect actually exists. So you see, all are significant. In December, it is also significant. From January to November, it is also significant. We'll try to see that what are the likely reason that why people are more likely to defer the loss, and why people are more likely to incur the gain earlier. Okay. So one explanation can be made with the help of prospect theory. So in prospect theory, you probably can recall that people are more risk averse in the gain, or people are more risk averse in the loss. In which case, you probably can recall. In which case, people are more prone to take risk, or people are more risk averse alternatively. Can you recall the concave utility curve? Can you recall?
Yes,
Can
sir.
you recall this diagram? Okay. So we drew this utility curve for which people? Risk neutral people, risk seeking people, or risk averse people? You probably can recall. Otherwise, you have to review. Can you recall that we have drew this kind of curve and we try to understand the expected utility, certainty equivalent, then the risk aversion.
Risk averse people, sir.
Right. It is for the risk averse people. Thank you. And it is for the risk seeker. Okay. And the straight line is for the risk neutral people. Okay. So now look at this this curve in this region and in this region. It is in the gain region and it is in the loss region, in which case people are more risk averse. I hope that you have not forgot the examples we discussed. Yeah.
Risk averse, sir. A area, sir.
Here people are risk averse.
গেইনের সময় সেল করে দেয় স্যার, গেইন অল্প একটু গেইন হলেই তো সেল করে দেয়, লসের সময় তো সেল করে না।
Okay, I'm not relating the disposition effect immediately. I'm just trying to remember you the prospect theory. I'll help you to relate the disposition effect with the explanation of prospect theory. Just try to remind yourself that what you have learned in prospect theory, in which region is risk averse region, which region is risk seeking region, in which case people look for risk. I hope that you have not forgot the prospect theory learning. It is the foundation of behavioral finance.
স্যার ডি এরিয়া রিস্ক সিকিং, সি এরিয়া রিস্ক অ্যাভার্স, স্যার।
I have separated the area into two parts. This is one part and this is one part. Now tell me which one is the area for risk seeking and which one is the area for risk avoidance. If you can recall the utility curve, you can immediately connect that why we are saying that this portion is risk averse, so this portion is risk seeking. Okay, without further ado, I just like to remind you that this portion is risk averse and this portion is risk seeking. And try to understand that how we can relate the disposition effect with the explanation of prospect theory. So let's try to think of the two investments. You are right now here. So if you have made a gain, you will go in the left region or you will go in the right region. You will go in the
Right region.
right region. Say from C, you have gone to D. Okay. Now, when you are in the D, you are more far from the risk seeking area relative to this position.
Yes, sir.
You are now more far. So when you are more closer to the risk averse region, more closer to the risk averse region, what will be your tendency? To hold the gaining stock or to sell off the gaining stock? If you are risk averse in this region, you will wait with the gaining stock and we'll see that what will happen in the future, or you will be selling the gaining stock as you are risk averse now.
I'll be selling it.
Because you don't want to see any more future. Okay, you will be go for selling it. So that is how prospect theory is trying to explain the disposition effect. Okay, now try to see here. Now, if you are in the B position and for some reason you have incurred more losses and you have shifted toward the point A, what will happen? You are more closer to the risk-seeking area.
Yes, sir, more closer.
More closer to the risk-seeking area. In that case, what will be in your mind? Let's try to see that time will come when my purchase price will be realized and I will not incur any loss. Let's try and wait. Let's see and wait what is happening in the future. It is a kind of tendency of the risk-seeking people. Let's see that what will happen in the future. Is it the tendency of the risk-seeking people?
Yes, sir.
They try to wait for the future. They try to look at how future will look like. Okay, so that is for the same reason. If you're risk-seeking in this region, you will be go for selling your losing stock, or you will be holding your losing stock.
I'll be holding
I'm
my losing.
holding, sir. As
So
I'm telling you.
that is how prospect theory is trying to explain that how disposition effect is prevalent, or why disposition effect is happening. Okay. So let's try to explain it further. That is, we already have realized that this concept we already have made clear that for regret, people go for postponing loss, and for taking pride, people go for realizing the gain. Okay. Now the thing is that let's try to make some further explanation that this is kind of emotional issue that people will be making regret or people will be taking pride. Okay. So there are debate that which is more true or which actually works behind the disposition effect. Is it the emotional effect more dominating, or the prospect theory more dominating, which is more convincing to explain it? Okay. So let's try to make more explanation with the emotional issue. So say you have a portfolio of some stocks, A, B, C, D. So you have a target allocation that how much you will make investment here, or how much of this, how much of this, how much of this. Say in C and D, in C and D, in C and D, say you have made loss. So if you have made loss in C and D, the percentage allocated, I mean, out of your portfolio to C and D will go down. I mean, in terms of market value. In terms of market value, your portfolio weight to the stock C and the stock D will come down. And if the stock A and B, the portfolio weight for the market value, if these are gaining a stock, your weight will go up in terms of market weight. You know the weighting? Okay. Say out of your 100 taka investment, you have made investment here 20, you have made here 20, you have made here 30, you have made investment here 30. Say in market, it has become now 40 in terms of market price, and it has become 35, and it has become 15, and it has become 25.
ওয়েট চেঞ্জ হয়ে যাচ্ছে স্যার।
Weight is changing. Okay. So to keep your weight constant, because you know that portfolio weighting is important for making the proper diversification. Otherwise, your diversification will be jeopardized if you do not maintain the weight properly. So you see that weight goes down for the losing stock, and weight goes down for the, weight goes up for the rising stock. Okay. Now, what will be your tendency, or what is the advice for you? The advice for you is to close this losing stock. I mean, close the C and D. Close the C and D, and add 2 more stocks, say E and F, which have similar risk profile like C and D, and invest in E and invest in F, so that the weight can be maintained again. So it is advised to close this and to include these 2 new stocks to maintain your portfolio weight appropriately. But you see that closing these stocks, C and D, I mean, say stock C is a kind of a stock in which you have your emotion. I mean, you love this stock for some reason. Or stock D, you have emotion for this stock because you are holding this for last 5 years. But for some reason, you are not selling this. Or for disposition effect, you are not selling this. You are not rebalancing your portfolio by selling the losing stock and by replacing the losing stock with some new stock and keep your risk profile intact. You are not doing this. Why we are not doing this? So there are some possible explanation. So when people do mental accounting, people do not go for relating C and D with E and F. People think of C and D separately. People think of E and F separately. They do some mental accounting. They do some allocation in different stocks, and they do not try to think of this portfolio as an aggregate. So that is one of the explanation from mental accounting why people do not go for this. And another explanation is that people like to feel that if I go for closing this, if for some reason, say after 2 months, if it turns out that C has reached to 35 and D has reached to 30, I will make regret for selling this, or I will make regret for closing this. So it's better not to close this. So for avoiding regret, people do not go for closing this and replacing this with the new stock. Have you got some emotional explanation for the disposition effect? Have you got it?
Yes, sir.
Okay. So Another concept we like to discuss, that is house money effect, which is related to the investor sentiment and also the feelings, mood, these things. That is how mood changes, how the risk appetite changes in the investors. So it is like that when people go to casino, it is very likely that in the first phase, people make a good amount of gain. And when people make a handsome amount of gain in the first phase, they feel that it will be better to take more risk in the second phase. So you see, if we try to think of it as a path, it is in the first phase, you have made an enormous gain. And after having the enormous gain in the first phase, when you are in the second phase, now you are likely to take more risk. It happens in the casino. But what is observed, that he actually made loss in the second phase. And alternatively, if in some business, if people make losses in the first phase, first time, in the second phase, it is observed that people go for taking less risk because they feel that they have already incurred a significant loss in the first phase. So it will be better to take less risk now. So you see, taking a risk in the second phase here is getting influenced by the outcome of the prior event, prior success or the prior failure. Have you got it? So when there is a successful investment, it causes elation. And it also drives pride. And it also drives greed. And when for some reason the investment turns out to be bad, it causes distress, and it also reduces the risk appetite of the people. So what we are finding, the prior gains and prior losses from the investment changes the risk appetite of the people. So this concept has been coded as the house money effect. Have you got the concept, house money effect? Yes, no?
Yes.
Do you face this? I mean, do you experience this house money effect among yourselves?
Yes, sir, sometimes.
Sometimes, okay. So let's try to see some explanation why house money effect happens. So when people have gain, they are less likely to exhibit the loss aversion bias. So they feel that they are they will be taking or they will be more confident, or they will feel that they'll be able to take more loss, or they will be absorb more losses. when there is a gain. But when there is a loss, the opposite thing happens. So let's try to see some more explanation. That is, because we see that symmetry might suggest you should become more risk averse after losses. So we already have made this point clear that when we incur losses, we become more risk averse. So it has been compared with an effect that is snake bit effect. So when we make a loss from our investment, it will be better to reduce our loss exposure. But sometimes it has been found that after incurring losses, people go for taking more risk. People tendency to take risk goes up. So one research has been done on the experiment of the game show. Of a game show, I do not know whether you have heard about this game show or anyone has watched this game show on the YouTube. It was very popular in the 2010s decade, and it was broadcasted in a good number of countries. Deal or No Deal. Have you heard about this game show? By any chance? Deal or No Deal? This is interesting, a game show. If you have not watched it yet, what can you do? You can search for Deal or No Deal game on the YouTube, and you will also see some recorded event. Anyone? Okay, no one. Okay. So let me give you a brief idea that how this game actually happens, or how this game is played. Okay. For the contestants, some suitcases are kept locked. So in this way, how many suitcases? 26 suitcases. So inside each of the suitcase, there is a certain amount of money. So that money ranges from very small pence to 5 million euro. So each of these 26 suitcases contains a specific amount of money, which is in between this range. But there is no idea that which suitcase contains how much money. So each contestant is given a chance that you will pick one suitcase So in this way, up to 6 suitcases will be taken by the contestant. So contestant does not know that which suitcase contain how much money. So it is a kind of blind idea. So randomly they pick a suitcase, and it might contain a very low amount. it might contain a very high amount. Okay. So after taking a certain suitcase, say it has been taken here by the contestant, and now the game host of this game show, Deal or No Deal, asked the contestant that I will give you an offer of a certain amount of money from the bank, and now decide that you can take this certain amount of money and stop playing and go to your home. And if you do not take this, you can take up to 6 suitcases in this way. I mean, after taking each of the suitcase, I will give you an offer that you have to decide that between this and between this, which one you will be taking. So it is very difficult. And it is not always the perfectly substitute of the amount which is inside the suitcase. So it has been found that when the contestant finds that when contestant disagrees that I will not take this, I will continue playing. I will not take this, I'll continue playing. So when contestant has decided that I will not take your certain amount of money, what happened? It is the no deal. I'm not taking your deal. But if contestant is very, very risk averse, contestant will say that I will not open the suitcase. I will take your offer and I will stop playing. That in that case, it is deal. So what will happen if for some reason it has been found that contestant disagrees with the deal? I mean, contestant has made no deal. Contestant has decided to continue playing, and then contestant discovers that the amount here is a very low amount. The amount is here a very low amount. Now you see, but say the amount here was a greater amount. So by making no deal, contestant has made loss. Contestant has made loss by taking no deal. If it turns out that the suitcase contains a very small amount of money here relative to this amount. So it has been found that in that cases, contestants are very likely to avoid any kind of deal and continue playing, again, continue playing. So if you, why we are continuing? So there is a tendency that what contestant believes that after each phase, contestant gets chance to open the suitcase. So for some reason, say, if this suitcase is opened by the contestant and it has been found that there is a very small amount, in that case, it is very likely that the big amount is within any of these remaining suitcases. Is it clear now? What contestant will be clear when the contestant will open the suitcase and finds that the amount is very low here. In that case, immediately what he will believe? He will believe that the big amount is in any of the remaining suitcases. Are you getting the issue? In that case, at the same time, though the big amount is in any of the remaining suitcases, it can also be like that an amount smaller than this amount is also among any of the suitcases. So there is no guarantee that the suitcase what the contestant will be selecting in the next phase will be the suitcase in which the big amount is there. So there is still uncertainty. So that's why it has been found that when contestant discovers that the amount is low, he tries to take more risk by putting off the option to take a certain amount of bank offer from the game host. So in this way, deal or no deal game is played, and it has been found that when the people feel that they are in the loss position and they are likely to take more risk. So you probably can immediately recognize that it reflects the conclusion of prospect theory that when people are in the loss region, they are likely to take more risk. So that is how the deal or no deal game is played, and house money effect. You see how house money effect is influencing. So say you have incurred losses in the first phase. So each of the phase when you will be playing in the upcoming time, the outcome in the first phase will affect your mind that what kind of risk you will be taking in the second phase or third phase subsequently. If it turns out that the suitcase contains a very big amount, in that case, your tendency for taking risk will become lower. So in the second phase, it may be like that you have decided that I will go for the bank offer, I will not play anymore. I mean, when people have more gain, they become risk averse. When people incur more loss, they become the risk seeking. Have you got it? The concept of house money effect? Yes, no?
Yes, sir.
So it is interesting. Okay. Now let me relate the deal or no deal game with the utility concept we learned in our earlier discussion. Can you recall the certainty equivalent? Can you recall the certainty equivalent? Yes, no? Or you have forgot, or we have not learned about the certainty equivalent in any of our classes. So what I'm trying to relate, the offer made by the game host, a certain amount of offer should be greater than the certainty equivalent amount. So certainty equivalent amount is what? Certainty equivalent amount is that amount in which the utility is equal to the utility from the expected wealth. Utility from the expected wealth, if what the amount of utility, you probably can recall that how can we measure the utility from expected wealth. So certainty equivalent is that amount of wealth in which I get the same amount of utility which I would get from the uncertain outcome. So from the uncertain outcome, we can measure the expected wealth, and by the utility function, we can measure the expected utility. And if I see that from the certainty equivalent amount, I get the same utility, in that case, I will stop playing the random game. In that case, I will be happy with the certainty equivalent. So to make someone convinced with a certain amount of money to stop them from playing the uncertain game or this kind of game, the offer, say the game host, what the game host is offering, that amount must be greater than the certain equivalent amount. Otherwise, the rational decision maker will not accept the offer. In this case, will not accept the deal and will continue playing by taking risk. So now we will be discussing how investor sentiment can be measured, and it is a difficult task. And I like to take a break of 10 minutes, then we'll resume from this slide. So we'd like to put concentration that is there any way that we can measure that how people are feeling, how people mood are reacting, or what kind of emotion people are currently holding? Because in aggregate, people feeling, people mood, and people's emotion, I mean, in one term, people's sentiment affects the sentiment of the market. So it has been found a number of papers. Okay, so it is really difficult. It is really difficult because it is a psychological thing, and measuring something which is psychological is absolutely difficult. So you probably can recall that sentiment can be classified broadly into two categories. One is exogenous and another one is endogenous. Okay. So one exogenous sentiment example, in addition to the examples what we already discussed in previous class, that is sentiment arises from airplane crash. So in one paper, the airplane crash, in one paper, it will be better to share with you, but what I'll do, I will share it in my classroom later after the class. What researcher tried to do, that he tried to relate the airplane crash and the stock market return. So what was his hypothesis is that airplane crash is a very significant event relative to the road accident. So airplane crash claims life of many people, maybe for a particular one country, and it causes a significant loss for the airplane company, airplane industry, and the consequential loss in other industries are not also insignificant. And when it is reported in the newspaper, it is reported in the newspaper with a good amount of importance, and it is also broadcasted in the media with a very good concentration, and attention of the people and emotion of the people get affected by the widespread publication or widespread broadcasting of the news of the airplane crash. Okay, let me ask you one question. Can you recall the airplane crash of US Bangla in Nepal a few years ago?
Yes, sir.
Okay.
Yes, sir.
Okay. Did you feel bad on that day?
Yes, sir.
Okay.
Yes, sir, definitely.
Okay. You see, in comparison, more than the same, I mean, more number of people are dying every day in our country in road accident. But we are not feeling bad in that way. Is it true?
True, sir.
Okay, so if for bad emotion, what kind of sentiment will be cultivated in our mind? We'll have a positive sentiment or we'll have a negative sentiment? We'll have a negative sentiment. Okay, if we'll have a negative sentiment, it is likely that we'll be taking less risk. We'll be taking less risk. That actually happens. So in that case, this kind of events, the data of this kind of random events are collected, which charge people emotionally and observe the economic activity of the people or observe the stock market return in our example and relate it with the number of airplane crash in a particular country. And on that day, what happens to the stock market return of that particular country, of which the airplane crash or of which country was the home country of the airplane. So this kind of sentiment, which are exogenous, are measured by collecting the data of these kind of events. So World Cup tournament, how countries are winning or countries are losing. So what can you do? You can look at the number of win or number of loss of the particular countries. So you can look at the events. So these are some exogenous sentiment example. Okay. Now, measuring the exogenous sentiment is relatively easy compared to the measurement of endogenous sentiment. So how endogenous investor sentiment is measured? So some direct indicators are, you are probably familiar, what will be better to ask from someone. Our Lanka Bangla Securities annually made a survey, makes a survey to ask the capital market expectation of the people. Are you familiar with this? Anyone? They make a survey and ask a few questions and ask people to rate that what kind of expectation you are trying to make on the stock market in coming year, and what will be the market return in the next year, and what will be the volatility. These factors are asked in some questions, and based on that, they make a report. Capital market expectation. Okay. So this kind of survey are made to know the sentiment of the people. So we'll try to make you familiar with some other surveys which are internationally recognized. So one kind of survey, one kind of way of measuring the endogenous sentiment is using the survey, which is a direct indicator. And some other indirect indicator, which are more interesting, that is looking at the market data, which are in relevant quantities. Say, our market in last day, total amount of transaction volume is more than 2,000 crore. Is a big number? But sometimes we see that transaction is in 300 crore. In which case you feel that people have a more positive sentiment. In 2000 crore transactions or in 300 crore taka transactions? On which day people have a more positive sentiment?
Sir, it depends which share he is holding.
I mean, from the aggregate market view,
Then obviously 2000.
obviously 2000. Okay. Now, IPO. If we look at the IPO performance on the first day, we see some return are more than 100%, more than 200%. And sometimes in the, I mean, when the time is not good, you would see that IPO is, but the thing is that when the time is not good, IPO is not floated. Okay, IPO is always floated in the good time. Okay, because the IPO issuers are more intelligent than the investors. So they know when it is time to issue their IPO. Okay, so sometimes you see the 10% return on the first day of the IPO, IPO of a particular company. Okay, in which case you see that people are having more positive sentiment. When the IPO percentage first day return is a very high percentage or very low percentage. Obviously, when the IPO first day performance is a very significant number or very abnormal number, in that case, we see that people have a more positive sentiment. It is a general conclusion. Okay, now, are you familiar with the closed-end fund? Are you familiar with the closed-end fund?
Not that much, sir.
Okay. Are you familiar with the mutual fund?
Yes, sir.
Okay, so if you're familiar with the mutual fund, closed-end and open-end fund are not very much special. The thing is that the closed-end fund cannot accept the subscription or accept the investment beyond a certain amount of time and certain amount of fund. They have a limit. But in case of open-end fund, they are open to accept the investment from the investors for unforeseeable time, and they do not have the maturity, but for the closed-end fund, they have the maturity. Okay. So you see that in closed-end fund, you will see that a good number of closed-end funds in our country are trading below net asset value. You probably have heard about it, net asset value. So it is simply, in simple concept, it is total assets of the fund minus the total liabilities divided by the number of units. So it is measured as the NAV per unit for the mutual fund. So a mutual fund should be traded at a NAV, and if there is any transaction cost in purchasing or selling, a small amount of transaction cost may be adjusted, but NAV should be the trading price of the mutual fund. But if you see the NAV and the trading price of our fund, you will see that the market price of many of our closed-end funds are far below than the net asset value. So the NAV mutual fund is reporting, say, 15 taka, but that mutual fund is selling at 10 taka market price. So it is actually, I'm ignoring any other accounting issues or fraudulent issues, I'm believing that 15 is the actual NAV of that fund. But if you see that mutual fund, closed-end funds in particular are trading at a very deep discount from the NAV, you tend to believe, or you should believe, that people sentiment are low sentiment, or people have a negative sentiment. So it is for the aggregate market. It is for the all closed-end fund average discount. It is not for a particular mutual fund. But if you see that mutual funds are not trading at a very deep discount, you would believe that people have a good sentiment or positive sentiment. So it is not the phenomena of our country that only in our country the closed-end funds are traded at a discount from the NAV. It is also the behavior of investors in developed countries, that they tend to trade the closed-end fund at a price which is less than the NAV. And when the discount is a very big, it is likely that they have a negative sentiment or they have a low sentiment. And the opposite is true when they trade at a very close to the NAV price or NAV value. Have you got some factors which we have mentioned to measure the sentiment? We will see that list in subsequent slide. Okay. So what are some direct indicators? It is for the endogenous sentiment. So one index is Investors Intelligence Index. Investors Intelligence Index. So what is done here? Survey questionnaire is sent to the institutional investors, and they are asked some questions based on the what will be happening to the market in coming days. And after getting the answer from them, these answers are compared. So it is compared that how much of the institutional investors are bullish and how much of the institutional investors are bearish. And based on the difference, the institutional sentiment is measured. So this is kind of institutional sentiment measure. And another interesting measure of sentiment is the American Association of Individual Investors. So it is also kind of questionnaire. This is sent by this association. You will find the site of this institution or association in the web. If you search for it, you will see that they report the sentiment of the retail individuals. I mean the individuals, I mean a good number of individuals, I mean 1,000 numbers, more than thousands. I can't recall that how many thousands people are asked about their expectation. Based on that, based on the answer from the people, this sentiment is measured. And another similar thing is Michigan Consumer Confidence Index, and it is based on the economic parameters, but consumers are asked directly about the, say, inflation, say their monthly income, say their purchasing power, say their unemployment benefit. These things are asked from the consumer, and based on the responses from the consumers, this sentiment index is measured. And another one is Conference Board Consumer Confidence Index, and another one is OECD Consumer Confidence Index, and this is the association of a number of countries for development, and they also publish a consumer confidence index. So these are some measures which are direct indicators by using the survey. So what we will try to see some indirect measures. There's a correction, it should be indirect measures. Indirect indicators. Okay. So we already have mentioned what kind of indirect indicators are used to measure the sentiment. So we do not have the bond mutual fund, but in developed countries, bond mutual fund is very present, like the equity mutual fund. In our countries, most of the funds are equity mutual funds, though they have nowadays a very small amount of investment in bonds, then some startup companies also. But the thing is that it is very common bond mutual fund. So it is say, in short, it is written as mutual fund. If it is corporate bond mutual fund, it is written in this way, corporate bond mutual fund. So between equity mutual fund and the bond mutual fund, which one is riskier? Investment in which mutual fund is riskier?
স্যার একটা বন্ড বললেন আর একটা কি বললেন স্যার?
Equity mutual fund.
স্যার ইকুইটি মিউচুয়াল ফান্ড কি আছে?
Equity mutual fund is riskier. Okay. If we see that more flows are going into the equity mutual fund and more flows are out from the bond mutual fund, what we will try to believe? People are in a good sentiment, positive sentiment, or people are in a negative sentiment? More funds are injected to equity mutual fund, more funds are coming out from the bond mutual fund.
Sir, a balanced thing, a balanced environment.
I mean, funds are coming out from the bond fund, and those funds which are coming out from the bond fund, a significant amount of those funds, those amount of investment are injected to the equity mutual fund. In that case, what we will try to believe about the sentiment of the people? People are taking more risk by injecting more of their investment in the equity mutual fund.
Sir, that can only be measured by technical analysis, because we need to identify the entry point and the exit point. If the situation is on the entry point, the risk is low.
But there is an aggregate flow. I mean, there is a report that on daily, weekly, or monthly, that how much of the bond mutual fund, how much is inflow and how much is outflow in the bond mutual funds in aggregate. There is a report. Okay. And every day there is also a report for the equity mutual fund. And now, if you compare, if you see that inflow in the equity mutual fund is rising and outflow of the bond mutual fund is rising,
then sir, it will become a risky situation, because the EMF can be overbought and the price can fall anytime.
Right. So in that case, what we will try to believe about the people's sentiment, I mean the investor sentiment, they are in a positive mood or they are in a negative mood in aggregate? If they shift more toward the equity funds?
Sir, in a positive mode.
In a positive mode. Okay. Now, another factor is kind of implied volatility, VIX index, volatility index. It is also available in the web. If you search for it, you will see that when the COVID-19 is spreading out in the last year, this index went up to a high number. So we already have talked about the IPO performance and the IPO activity. When you see the number of IPOs are coming out in the market, the number is too high or too many. In that case, you have to believe that market is in a positive sentiment mood. So based on this, the sentiments are measured. So we will try to concentrate on one particular sentiment index measure, which is a kind of indirect sentiment measure. And we will spend time to understand how the sentiment has been developed by these two authors. So Becker and Ugler, Ugler is a Harvard University professor. So they came up with a sentiment index in the 2006 by taking some indirect indicators and doing some statistical analysis. And this statistical analysis is known as principal component analysis. So it is a kind of advanced statistical tool, principal component analysis. So what is done, what is to be learned, that is, they have taken these factors and they have collected the data of these variables. One is trading volume as measured by the New York Stock Exchange turnover. I already have mentioned when the trading volume goes up, it indicates a positive sentiment, and the vice versa. So one thing I like to explain, that is the dividend premium. Okay. It is the difference between the market to book value of the companies which pay dividend and the market to book value of the stocks which do not pay dividend. The difference is used as dividend premium. Now, between the companies who are dividend payers and who are not dividend payers. So you see that when investors are confident, they will like to take more dividend, or they will like to keep the dividend with the company and believe that the amount will be invested by the company by keeping that dividend as retained earnings, and that will increase the growth of the company and will pay a hefty amount of money later to me. So when the investor is confident, which will be preferred by investors? Taking the dividend or not taking the dividend?
So taking the dividend.
When investors are confident, when investors are in a positive sentiment.
Not taking the dividend.
Not taking the dividend, because they tend to believe that company will be taking care of that money, and that this will be invested by the company, and it will give a good amount of return later. So if the investors are in a negative sentiment, what they will prefer? What they will prefer if the
They will
investor
take dividend.
taking out the dividend immediately, right? Okay, so if they try to take out the dividend immediately, in that case, which company's market value will be higher? The companies which are paying dividend or the companies which are not paying dividend?
Companies which are paying dividend.
Which are paying dividend, they will be demanded more by the investors. Okay, so the difference between the market value and the book value of the dividend paying company and the non-dividend paying companies is measured as the dividend premium to reflect the investor sentiment. Have you got it? How it is related to the sentiment? How it is connected? The dividend premium, the preference of the investors differ for these companies when the sentiment changes. Okay, that's why these are kind of indirect indicators. Okay, number of IPOs I already have mentioned. Okay, so in last couple of months, you have seen a number of IPOs in our country had been floated. So you can immediately recognize that the sentiment has been good. That's why the IPOs were successful. Okay. Then the average return on the first day returns on IPOs, I already have mentioned about it. Equity share in new issues. So number of equity share in the new issues, it is not necessarily, I mean the in IPO that how many new shares are issued. So it can also be secondary, I mean the repeat public offering, RPO, when new equity shares are issued for the second time, or for it can be for the third time. So all these variables relate to the propensity of investors to invest in equity, and thus all are indirect index of their optimism. So which we need to be clear that how it is developed. It is developed, it will be better to take you to the Googler site where this sentiment index is available. Then we'll see. Okay. If you search for Baker and Googler sentiment index, you will see here. Okay. Sorry. Ugler is not a Harvard University professor. Ugler is a New York University professor. So if you, it is the first, it is the web page of the Ugler's personal web page, and this sentiment index is available in his page. Okay, you see the investor sentiment data. So it is it has been made available for free. Okay. Now, if I open this, you see that this sentiment index, it is, I will explain about the orthogonalized sentiment index and unorthogonalized sentiment index. The inverse T is an orthogonalized sentiment index from this paper. And you see the variables which we just have discussed. So it is the dividend premium, then the first day return from the IPO, then IPO volume, then closed-end fund discount, which has not been mentioned in the slide. I mentioned to you closed-end fund and the equity share in new issues. And the definition have been made clear, very clearly here. Okay. Now some influencing factors have been taken. So what are those influencing factors? Influencing factors for what? Influencing factors for these variables. So what are those influencing factors? Industrial production index, then nominal durables consumption, nominal non-durables consumption, nominal services consumption, then National Bureau of Economic Research recession indicator. This authority declares that from which period to which period recession exists, and the employment index and the consumer price index, you know, it is a measure of inflation. Okay. So one thing you have to note, this one, you see, the first one is here, trading volume, right? Trading volume. Okay. But you see what they have mentioned, that they recently discarded this variable, NYC turnover has been dropped from the measurement of the sentiment index. So what is the reason? They have mentioned that recently there has been a development of the high frequency trading for the development of the trading in multiple venues and the online trading. There has been development of the high frequency trading where the real number of trading is less than the actual number of trading. So for the development of the high frequency trading in the financial market, they have found that this turnover volume is no longer a valid measure of the sentiment index. Okay. So what are where are the data? The data here, they have provided the data. These are the sentiment index. Okay. So I'll try to show you. So these are the variables which are the indirect indicators I just have mentioned. And these are the influencing variables. Okay. So you see the sentiment index chart here. And you see, can you recall any immediate bubble in the financial market? Can you recall the period when the subprime financial, subprime mortgage crisis happened? In which period?
In 2008, sir.
From 2008 to it continued up to
2010, after the recession, I think.
Okay. So during that period, what do you expect? The sentiment of the people will be in a good mood or in a negative mood? What is your expectation of the sentiment?
In the bubble, investors were in the good mood.
During the bubble, the sentiment in a positive mood, but in the when the bubble was bursted, the sentiment was in a negative mood. Okay. You see, bubble developed in 2008 up to early quarter of 2009. But when it bursted in the 2009, it continued the up to 2010. I mean, on the late 2010, and you see the sentiment went up during the bubble, and sentiment went down during the after the bubble, after the burst of the bubble. Okay. And at the same time, in the late 90s, when the dot-com bubble bursted, late 19, when the dot-com bubble bursted, the sentiment went down. And you see the declining sentiment during that period. And there are, so we need to make one thing clear, that how this sentiment index is measured. So one thing is like this, that they do some orthogonalization. Orthogonalization. So what is it? So you see that these are some sentiment indicators. So what we are doing from all of these sentiment indicators, Y1, Y3, Y4, Y5, can you recall the influencing factors? Industrial production, then consumer price index, then the non-durable consumption, durable consumption. Can you recall those influencing factors? So those factors have influence on each of these factors. So what is done, the influence of those factors have been separated out from these factors. The influence of the influencing factors have been separated or the economic factors have been separated out from these factors. So one, there's a remaining here. I mean, when you have taken out the effect of the influencing factors, still there are some values within each of this indicator. Say, for example, one value is 20 for a certain variable. So you have measured that 14 is happening for combinedly for the industrial production, then the inflation, then the consumer durables, durable consumption, service consumption, these factors. You have estimated by statistical analysis that 14 out of this 20 is happening for this. Now, what is remaining? 6. I'm trying to make a simplify. I'm trying to simplifying the understanding because I'll not make the things, statistical things very clear here. But let's try to understand the simplified version of this sentiment index. Are you getting? Out of the 20 of a certain variable, 14 is coming from which factors? These factors. What is remaining? The 6 is remaining. And the conclusion is that this 6 is included in an equation to measure the sentiment index. 6 for what? 6 for Y1. And let me try to refer the equation. That will be better. Okay, what is this one? This is the paper. Okay, you see the equation. You see an equation. So for each of the factors, you see the turnover, then the IPO, this one. So if I put, say 6, we have measured 6 for a certain variable, say 6 here. And for each of these variable, we can come out, we can come up with this number for each of these variables, sentiment indirect indicators. Then what can we do? With the help of the multiplication with the coefficient, we can come up with the sentiment index for that period. Okay. So remember, these are technical things. We are not trying to make the things testable for the exam. Just get an idea, that high level idea, that how it happens or how it works. Okay. So in that way, sentiment has been measured. So there's a, you see the chart of the Becker-Ugler sentiment index. And you see when it peaked, you see some blue shaded bar. You see some blue shaded bar on the background. Yes, no?
Yes, sir. Yes, sir.
Okay. So these are the NBER recession period. So what is expected? In the early of the recession, there has been a boom. So you see, I mean, boom in the economic activity, and also sentiment of the people are also very positive. And you see in the very beginning of the recession, you see sentiment is at the peak. And you also see that in the beginning of from the November 2007, you see when the recession has started, you see the sentiment is at the high level. And also sentiment dropped when the bubble bursted. But make it clear that sentiment has to be independent from the economic recession. You see that sentiment is rising upward, falling here, but there has been no presence of recession, right? Is there any recession here? But you see that sentiment has gone up, sentiment went down, sentiment went up, sentiment went down, but there has been no recession. So recession is a separate thing and sentiment is a separate thing. We are right now interested with the sentiment. Obviously, sentiment might have received some influence from the recession, but recession should be separated out from the sentiment. Can you recall that Becker and Ugler has taken an influencing variable which indicates the NBR economic recession? Can you recall this?
Yes, sir. Turnover.
In this one, they have taken this. What's the purpose? The purpose is to separate out the influence of the recession from this variable. From this variable, the influence of these factors have been taken out, taken away. And the remaining is the sentiment. Remaining is the Baker and Ookla sentiment index. Have you got it? So the sentiment index does not include the effect of the recession anymore. Okay, so let's continue. So when sentiment is high, what is your expectation? The securities will be overpriced or securities will be underpriced? Say currently the sentiment is very high. What will be your expectation? Our on an average, the security price will be overpriced or security price will be underpriced? If the sentiment is very high,
Overpriced.
securities tend to be overpriced. Okay. Now, if people end up buying some securities at overpriced, his future return will be lower or higher?
Lower.
Lower. And apart from the investor's perspective, if you see that some securities are overpriced for the positive sentiment of the people, what is the expected return for that security in the future or in the next period when the sentiment will come down? Return will become lower in the future because the securities has been overpriced for the high sentiment in the market. Okay, so when the fundamentals will be revealed in future, it will be found that the price should be lower than the price at which it is traded. And why this price has become very high? Because of the positive sentiment or because of the high sentiment. Okay. Can you recall that when we started our this lecture from the previous class, how we started that there are two measures of risk. One is risk as analysis, one is a risk as feelings. Can you recall? Can you recall this? Yes, no? I forgot everything.
So forgot it.
Okay, you see, risk as analysis and risk as feeling. So sometimes we measure risk by our feeling, but that measure will lead us to take the wrong decision. But the thing is that why people measure the risk as feeling? Because of the sentiment. Okay. So when people are in a positive sentiment, people will underestimate risk or overestimate risk with their feeling. If people use feeling for measuring the risk, they will underestimate the risk. Yes, no, very quick.
Underestimate করবে।
Underestimate the risk. Can you recall that how you measure the expected price or the value of a stock? Cash flow divided by 1 plus expected return, right? You do this? Have you seen this?
Yes, sir.
Okay, for many times, right? Okay. Now, this includes risk. This includes risk. Does this include risk measure? When you make the measure for expected return, does this capture the risk also? No? Yes? No response? How we build up our expected return? We develop our expected return by analyzing our risk.
So it measures risk.
It also reflects risk. If the risk is very high, your expected return is expected to be higher. If the risk is low, your expected return is expected to be lower. Okay. Now, if you underestimate the risk, you will also underestimate the expected return. In that case, what will happen to this? It will be overestimated or it will be underestimated. The price will be overpriced or price will be underpriced. For underestimating the risk, why we are underestimating the risk? Because we are in a positive sentiment. By feeling, we are thinking that risk is low. That's why we are underestimating the expected return and we are overvaluing the security. Are you getting the things? How sentiment translates to the analysis of the valuation, how sentiment affects the valuation and the future return. So when we end up evaluating something at a high value, and we tend to believe that this should be the price, and we end up buying something at a high price, we should expect that future return will be lower. So you see that what we are here, that if the sentiment is high currently, the future return will be lower. And if sentiment is low now, what will happen? If sentiment is low, what does it mean? If sentiment is low, we will underestimate the risk or we will overestimate the risk.
Overestimate, sir.
We will overestimate the risk. And if we overestimate the risk, we will overprice the security or we will underprice the security.
Underpriced, sir.
We will underprice the security. Now link it up. If we underprice the security, and if in the future the return from that security will be higher or lower, because investors have underpriced the security for the negative sentiment in the previous period.
Risk will be lower, sir.
Sorry?
So risk should be lower because it's underpriced.
Yeah, risk should be lower, but what will be the future return if someone
High
buys the
return, sir.
security?
High return.
Future return will be higher. Okay, so that happens how sentiment influences. Okay, so what Becker and Ugler additionally did, that they tried to analyze the cross section of stock, that to check that does the cross what does it mean, cross section of a stock? So if you have the universe of a stock, why the returns of the different stocks are different, and what is the reason for the difference of the return of these stocks? So analysis of that is cross section of a stock return. So you probably have heard about the Pharma Friends, right? You probably have heard about the Pharma Friends 3 factors,
Yes,
Pharma Friends 5 factors. So they came up with some factors which are responsible for the cross section of return. So one is market beta, another one is size beta. You probably can recall from our earlier discussion, one is the value beta. Okay, so they have come up with these are Pharma Friends 3 factors. So these are responsible for the cross section of stock return by the Pharma Friends. Okay, but what Becker and Ugler additionally did, they additionally took the sentiment beta. They tried to understand that if does the stock return vary for the variation in the sentiment beta of these stocks. So it has been found that, okay, I'll share the findings later, but what is hypothesis? The hypothesis is that it will be better to discuss from here. Okay. If I ask you that some stocks are mature, stock of mature company, which are dividend paying, which has a business of 100 years, say Bata Shoe, then the what is another, say GlaxoSmithKline, which has been now Unilever Healthcare. Is now Unilever Healthcare?
Unilever Consumer Care, sir.
Consumer Care, sorry. Yeah, Unilever Consumer Care. So these are, these companies have a long history. Okay. These companies have a long history. Then the Renata, these companies have a long history. Okay. But alternatively, there are some securities which are speculative. Speculative. Okay. Now, if I ask you between these two kinds of stocks, which stocks are likely to be more volatile?
Speculatives.
Speculative stocks are likely to be more volatile. Now, if arbitrageurs want to capitalize the mispricing, you know the mispricing, that some stocks are traded at a price which is less than or greater than the fair value. In that case, arbitrager can capitalize this mispricing and make profit out of this mispricing. Okay. So what you have, if the volatility of speculative stocks is higher, what do you think? The arbitraging of the mature stock is risky, or the arbitraging of the speculative stock is risky? You can't forget the noise trader risk we learned in earlier classes. So in which case noise trader risk will be higher? In which case the arbitrageurs
speculative in the
right.
speculative.
In a speculative, noise trader risk is very high, and in which case arbitrageurs activity will be very difficult.
The mature stocks, very more information are available for the stocks.
Obviously, more information are available, but in terms of volatility, which is riskier for the arbitrager to engage in the arbitraging?
Riskier, sir, for arbitrageurs, speculative.
Speculative will be riskier. So in that case, it has been hypothesized that these speculative stocks will be more prone, will be more sensitive to the sentiment movement. If the people's sentiment are very high, people have a very positive sentiment, these speculative stocks tend to be overpriced. And if people's sentiment comes down, these speculative stocks will tend to be underpriced relative to the matured stocks. Have you got it? Is it convincing? Is it convincing? Why the sentiment sentiment exposure of a certain speculative stock should be greater relative to the matured stocks?
Yes, sir.
Okay. Remember, sentiment drives the retail investors. Sentiment, it is commonly believed that sentiment drives the retail investors. But nowadays, it has also been found the evidence that institutional investors also try to capitalize the sentimental movement in the market. So if some stocks, for example, are getting overpriced for the sentiment of investors, institutional investors also try to play in the right. Okay, it has been found. Okay, we'll try to share the evidence later. Okay. So the picture is showing the sentiment beta. What is your expectation for which sentiment beta will be higher? For the stocks which are safe, easy to arbitrage a stock, or for the stocks which are very speculative and difficult to arbitrage a stock? For which stocks sentiment beta will be higher? Let me share that how sentiment beta is measured. Have you seen that sentiment index? Have you seen the sentiment index here by Baker and Ugler? You see, these are, okay, here. These are sentiment index. You see the sentiment index? You see? These are sentiment index. Got it? For each month. For each month, sentiment index are here. Okay. So how sentiment index, sentiment beta is measured? So sentiment beta is measured by covariance of sentiment index, orthogonal sentiment index, and the stock return divided by the variance of the sentiment index. Can you relate it with the market beta measurement? How market beta is measured of a particular stock? Sorry, return of the market, return of the stock, divide this number by the variance of market return. Is it? Is it the way how variance beta is measured? It is for the sentiment beta. It is for the beta of market. I mean a beta of a stock. Okay. Can you link it with this? How sentiment beta is measured? Yes, no? You should say at least no or yes.
Sir, what's T?
Where? This one.
Yes, sir.
This is for sentiment for each month. Say, for example, right now 21, it is now May. So if we start, say, for example, 21 to January, in that case, T will be 1 for here and T will be 5 here. Have you got it? I mean for the time index, nothing else. Okay. I mean for each period, T index is used here, nothing else.
Okay.
Got it? How sentiment beta is measured? You're very familiar with how stock beta is measured?
Yes, sir.
Do we have our portfolio manager?
Yes, sir. I'm here, sir.
Is it okay? Is it right that how stock beta is measured?
I think so, sir.
You think so? Okay. So in that same way, sentiment beta is measured. Okay. So based on our earlier discussion, what is the for which stock sentiment beta is to be higher, for a speculative stock or for mature stock, or for mature company stock?
Speculative stocks, sir.
So you see the picture here. You see how it is standing up. So what is happening? What Becker and Ugler did, based on the volatility, based on the volatility of what? Volatility of monthly return. They have made the decile. We have talked about decile. In decile, how many groups are there? In decile, there are 10 groups. So all stocks have been allocated into 10 groups, and based on what? Based on volatility of monthly return. And this is the 10th. This is the 10th, and this is the one. And which stocks will have more volatility? The speculative stocks will have more volatility, and the safe and easy to stocks have very least amount of volatility. Okay, but what we are observing, we are observing as volatility is going up and stock is becoming more and more speculative, stocks are here. Those stocks will have high sentiment beta. Okay, now what is your expectation if the sentiment beta is higher for these stocks? And this, what does it mean? If the sentiment goes up, this stock will tend to be overvalued, or these stocks will tend to be overvalued. What does that mean?
Speculative stocks will be overvalued, sir.
Speculative stocks will be overvalued. In that case, speculative stocks will give higher return when the sentiment is high. And if the sentiment is high in current period, what is the future return for the speculative stock? What do you believe?
Should be lower, sir.
It will become lower, right? It will become lower. It has exactly been found. You see that it is for the overall average stock. I mean the dashed, not the dashed. I mean the solid black line. And you see dotted line here. This is the dotted line. This one is the dotted line. And this dotted line is applicable when there was high sentiment in the previous month. High sentiment in the previous month. What you hypothesized, which stock will give lower return when the sentiment in previous month is high? The speculative stock or the safe or easy to arbitrage stock? Speculative stocks will give low return relative to the market when the sentiment in the previous month is high. Remember, there is a lag. I mean the previous month, try to link it up. Previous month sentiment is high. That means in that month, the stock was overpriced. That's why in current month, the stock will give low return. You see, this has become down here. I mean the dotted line. This dotted line is now in a very low region, in a negative region. You see negative return and average monthly return for which stock? The speculative stock. For what reason? Because those are got influenced by the sentiment. But you see the stocks which are not influenced by the sentiment, they are providing higher return in the future month. Okay, they have not been influenced by the sentiment beta, or they have not been influenced by the market movement in the sentiment. But you see the opposite picture, say when the sentiment is low in the previous month, which stocks are likely to be influenced by sentiment more for low sentiment? Again, the speculative stock. So in previous month, the sentiment was low, but now you see the dashed line. You see the dashed line, this region, which stocks are providing higher return? Speculative stocks are providing higher return because for low sentiment, these speculative stocks in previous month were underpriced for underestimation of risk by feelings. That's why they are underestimated, or they are underpriced, and people who bought them or these stocks are now providing higher return because they are underpriced in previous month because of the low sentiment. But you see, that thing didn't happen for the stocks which are safe, easy to arbitrage stocks, which are not prone to fluctuation in the market sentiment. Okay. So in this way, you have to understand it, and let's try to summarize what we have learned so far in the Becker and Ugler Sentiment Index. That is, it has been based on the market-based indicators, which reflect the propensity of the investors to invest in the stock market. And by having these indirect indicators, what can you do? You can measure the sentiment index, and we have found that the index predicts next month stock market return negatively. So if the current month sentiment is high, you should expect the stock return in the subsequent month will be lower, and the opposite is true. And we also have found that the valuation, the pricing of the speculative securities are to be higher for the sentiment, because those valuation are sentiment driven. Which stocks? Speculative stocks. Okay. Now, if I ask you between small stock and the large stock, which are speculative, which are relatively speculative, between a small stock and large stock?
Small ones.
Small stocks are relatively more speculative. So you have to believe that small stocks tend to be influenced by the sentiment. Okay. And also the companies which come up with a very new idea of doing business, a very, very young, a very innovative idea, it's not still proved. Those stocks are also in this category, which will be influenced by the sentiment of the people. Okay. So when the index is high in year T, or you can understand it in month T, the return on the speculative stocks will be lower in the subsequent year or subsequent month. Okay. So in this way, Becker and Ugler concludes that sentiment is responsible for the cross section of a stock return. So we'd like to end up our discussion just by reading the abstract of this seminal paper together, that what they have found. We predict that a wave of investor sentiment has larger effect on the securities whose valuation are highly subjective and difficult to arbitrage. So we already have learned which stocks are in this category. So what they have found, we find that when the beginning of the period proxies for sentiment are low, subsequent returns are relatively high for small stocks. So these are in the same category: small stock, young stock, high volatility stock, unprofitable stock, non-dividend paying stock, extreme growth stock, and distressed stock. So these stocks are subject to get influenced by the sentiment fluctuation. So when sentiment is high, on the other hand, these categories of stock earn relatively low subsequent return. So it is very interesting paper and very dominating paper in the sentiment and also in the behavioral finance. So I like to recommend you to go through the paper later. I'll try to share the paper. So let